What I'm about to share with you today is not mainstream opinion, it's not Wall Street comfort talk, and it's definitely not what most gold and silver investors are being told right now. Because while the crowd is watching price action, the real story is happening underneath the surface, quietly, deliberately, and with consequences most people are not prepared for. And if you think you already understand what's coming next in the precious metals market, you may want to rethink that assumption. You have to understand something fundamental before you even begin to interpret the silver market properly, and that is the structure of how price is discovered today is not the same structure that actually governs physical reality. Most investors are operating under the assumption that what they see on the screen, the quoted price of silver at any given moment, is a direct reflection of supply and demand in a physical sense, but that assumption is where the entire misunderstanding begins to form. Because what exists in the paper market is not a reflection of actual deliverable metal in vaults, it is a reflection of contracts, leverage, and financial engineering that can expand or contract independent of whether a single ounce of silver has moved from one hand to another in the physical world. And this is where the disconnect starts to become not just theoretical, but structural. In the paper market, you have an environment where a single ounce of silver can be represented by multiple claims, sometimes dozens of claims, depending on the structure of futures contracts, derivatives, and unallocated storage systems. That means the same physical ounce is effectively being reused in multiple layers of financial promises, and as long as confidence remains intact, the system appears stable. But stability in this context is not the same as solvency, and that difference is what most investors fail to appreciate until stress enters the system. When you begin to look at physical silver demand, especially in industrial sectors, investment demand, and sovereign accumulation patterns, you start to notice something that does not align with the calm pricing behavior of the paper market. You see physical inventories tightening, you see delays in delivery, you see premiums expanding in certain jurisdictions, and yet the headline price continues to move in ways that suggest abundance. This contradiction is not an accident. It is a feature of a system that separates price discovery from physical settlement until the moment it can no longer do so. The key to understanding this lies in recognizing that the paper market is primarily a sentiment and liquidity mechanism, not a warehouse of actual metal. It allows large participants to hedge, speculate, and manage exposure without necessarily interacting with physical supply. But when enough participants decide that they no longer want exposure in paper form and instead want actual deliverable silver, the system begins to shift from a liquidity-based pricing model to a scarcity-based pricing model. And that transition is not gradual in the way most investors expect. It tends to be abrupt, nonlinear, and highly disruptive. What makes silver particularly sensitive in this structure is its dual identity. It is both a monetary metal and an industrial commodity. That means it is subject to investment flows driven by fear, inflation expectations, and currency debasement on one side, and on the other side it is consumed in manufacturing processes, where it is often not recovered. Solar panels, electronics, medical devices, and emerging technologies all consume silver in ways that permanently remove it from above ground investment circulation. So while the paper market continues to recycle claims, the physical market is dealing with a gradually tightening supply base that is not easily replenished at the same rate. Now, when you combine that with the leverage inherent in futures markets, you begin to see why small shifts in physical demand can create disproportionately large reactions when they finally transmit into pricing. Because the paper market can absorb pressure only as long as participants are willing to roll contracts, provide liquidity, and maintain confidence that delivery will not be demanded en masse. The moment that assumption begins to weaken, the entire pricing mechanism shifts from a managed environment into a reactive one. And this is where most investors misinterpret calmness for stability. They look at periods of relatively controlled price movement and assume that the underlying system is balanced. But in reality, those periods often represent accumulation phases where physical metal is gradually being absorbed by stronger hands while the broader market remains focused on paper pricing signals. During these phases, inventories can quietly decline without attracting attention because the visible price does not reflect the hidden stress building beneath it. You also have to consider the role of large institutional participants who operate on both sides of this structure. Many of them are not interested in taking delivery of metal, they are interested in maintaining exposure efficiency. But there are also entities that do accumulate physical silver strategically, not for short-term speculation, but for long-term positioning. When these two behaviors intersect, you get a market that appears balanced on the surface, but is actually experiencing internal divergence between paper availability and physical hoarding. The most important psychological element in all of this is that the average investor is conditioned to believe in continuity. They assume that because a system has functioned in a certain way for years or decades, it will continue to function in the same way going forward. But financial systems do not fail gradually in most cases. They fail when structural imbalances reach a threshold where marginal participants can no longer maintain equilibrium. In silver, that threshold is not defined by price alone, it is defined by physical availability relative to contracted claims. When that imbalance begins to surface, it does not always appear as a dramatic headline event at first. It can show up as subtle changes, increased volatility during specific trading sessions, unusual behavior in leasing rates, widening spreads between spot and futures, or regional dislocations where physical metal trades at a premium that is not reflected in global benchmarks. These are the early signals that the paper mechanism is beginning to strain under the weight of physical reality, and yet most market participants continue to focus on the visible chart, the technical patterns, and the macro narratives that are widely distributed. They analyze inflation data, interest rate expectations, and currency movements, all of which are relevant but still secondary to the core structural issue, which is whether deliverable silver is sufficient to meet the obligations that have been created in synthetic form. Because when confidence in delivery begins to erode, the pricing mechanism shifts from a consensus-based valuation model to a competition-based acquisition model. In that environment, price no longer acts as a stable reference point, it becomes a clearing mechanism. It moves rapidly not because of speculation alone, but because participants are forced to adjust positions in real time in order to secure physical exposure. And that dynamic creates conditions where historical price relationships no longer apply in the same way, because the underlying constraint is no longer liquidity in paper contracts, but availability of actual metal that can be held, transported, and stored outside of the financial system's promised structure. What makes this even more significant is that silver is not just consumed, it is often consumed irreversibly. Unlike gold, which tends to be hoarded and recycled through financial systems over long cycles, silver in industrial applications can end up dispersed in quantities that are not economically viable to recover. That means each cycle of industrial expansion effectively reduces the above ground investable supply pool, even if mining production continues. And mining production itself is not elastic in the short term. It responds slowly to price signals due to capital intensity, permitting delays, and geological constraints. So what you end up with is a system where paper claims can expand rapidly in response to financial demand, but physical supply contracts slowly and silently due to structural consumption patterns. Over time, this creates a divergence that is not immediately visible until it reaches a point where paper confidence can no longer suppress physical reality. And when that moment arrives, the adjustment is not orderly in the conventional sense because it requires repricing an entire structure of leverage that was built on assumptions of continuous availability, and this is where the behavior of investors becomes critical. Those who understand the distinction between paper exposure and physical ownership tend to position themselves differently long before stress becomes visible. They are not reacting to price movements in the short term, they are observing structural signals that indicate whether the underlying system is tightening or relaxing. And once they recognize tightening conditions, their behavior shifts from trading to accumulation, from speculation to positioning, from liquidity reliance to physical security. At the same time, the majority of participants remain focused on short-term volatility, reacting to each movement as if it is self-contained, without recognizing that each cycle of compression in the paper market can contribute to deeper stress in the physical market. Because every time paper supply expands without corresponding physical backing, the gap between perception and reality widens slightly more, until eventually it becomes impossible to bridge that gap without a repricing event that aligns both systems again, and that alignment process, when it begins, does not wait for consensus. It forces consensus through price discovery under constraint conditions where availability becomes the dominant factor rather than sentiment or macro narrative or technical structure or even historical precedent. And at that stage, the behavior of the market transforms into something that resembles a scramble for settlement rather than a smooth exchange of value based on expectation models that were formed in a fundamentally different environment altogether. You have not enough humanizer words left. Upgrade your surfer plan. When most investors look at central banks today, especially gold investors, they make a very simple but very dangerous assumption, and that is the assumption that central bank behavior is reactive, transparent, and primarily driven by short-term economic conditions as they appear in mainstream data. They assume that when inflation rises, central banks tighten. When growth slows, central banks loosen. When markets fall, central banks step in. And while there is a surface-level truth to that framework, it completely misses the deeper structural role that central banks play in the global monetary system, especially when it comes to gold accumulation and reserve strategy, because central banks are not simply economic managers responding to quarterly indicators. They are system stabilizers operating inside a long-term currency architecture that is constantly under stress from debt expansion, geopolitical fragmentation, and the declining confidence in fiat settlement systems. And when you view their behavior through that lens, what looks like inconsistency to the average investor starts to look like coordinated long cycle positioning that is not designed to be understood through conventional macro narratives. Most gold investors today are still anchored in the idea that central banks are either bullish or bearish on gold based on what they say publicly or what they report in quarterly data releases. But central banks rarely reveal their true intent in real time. Their actions are staggered, distributed, and often intentionally obscured through multiple channels including swaps, custodial reallocations, sovereign partnerships, and internal reserve adjustments that never appear in simplified public commentary. So what the public sees is only a fraction of what is actually occurring beneath the surface of global reserve management. One of the most misunderstood aspects of central bank behavior is the accumulation pattern that occurs during periods of monetary transition. When the global system is moving from one equilibrium state to another, central banks do not wait for confirmation from inflation reports or GDP revisions. They begin repositioning years in advance, quietly, incrementally, and often counter to the prevailing narrative in financial media. This is because they are not trying to optimize short-term returns. They are trying to preserve long-term monetary optionality in a system where trust in paper assets is structurally declining over time. What most gold investors fail to recognize is that central banks operate with a dual mandate that is very different from what is publicly communicated. On one level, they manage domestic monetary stability. On another level, they manage external reserve credibility. And gold sits at the intersection of both mandates as a neutral reserve asset that does not carry counterparty risk in the same way that foreign sovereign debt or currency reserves do. So when central banks increase gold holdings, it is not simply a bullish signal on inflation, it is a strategic repositioning of reserve composition away from instruments that carry increasing geopolitical and financial exposure. The misinterpretation happens when investors assume that central bank gold accumulation must correlate with visible economic distress or crisis-level conditions. But historically, the most significant accumulation phases often occur during periods that appear relatively stable on the surface. Stability in this context is not the absence of risk, it is the window in which large institutional actors can reposition without triggering market disruption or drawing excessive attention to structural shifts in reserve strategy. Another critical misunderstanding is the belief that central bank gold behavior is uniform across all regions. In reality, the global central banking system is not a single coordinated entity, but rather a network of institutions operating under different geopolitical constraints, trade dependencies, and currency exposure profiles. Some central banks accumulate gold primarily as a hedge against external debt exposure. Others do so to reduce reliance on dominant reserve currencies. Others are responding to long-term trade settlement shifts where bilateral agreements are increasingly settled outside traditional currency frameworks. This fragmentation creates the appearance of inconsistent behavior when viewed through a simplified global narrative. One region may appear to be increasing reserves aggressively while another appears static or even reducing exposure. But when analyzed as a system, these movements often reflect localized responses to a broader global transition in reserve architecture rather than isolated policy decisions. Gold investors often misread this fragmentation as contradiction rather than coordination under different constraints. They expect a uniform global signal, but what they are actually observing is a decentralized adjustment process that unfolds unevenly across jurisdictions depending on their exposure to currency volatility, to debt rollover pressure, and trade settlement exposure. And because these adjustments are not synchronized publicly, the market tends to underestimate the aggregate direction of movement until it becomes impossible to ignore. Another layer that is frequently overlooked is the role of gold leasing, swaps, and off-balance sheet arrangements that allow central banks to manage exposure without necessarily changing headline reserve numbers in a straightforward way. This creates a situation where reported holdings may remain relatively stable while actual physical positioning is undergoing significant internal reshuffling. For the average investor, this creates a false sense of inactivity when in reality the system is undergoing continuous structural adjustment beneath the surface. What is even more important is the timing of these adjustments relative to broader monetary policy cycles. Central banks tend to accumulate gold more aggressively during phases where real interest rates are volatile or where sovereign debt levels are expanding faster than nominal growth. This is not because gold is viewed as a short-term hedge against rate fluctuations, but because it functions as a long-term anchor asset in environments where confidence in sovereign balance sheets becomes increasingly sensitive to refinancing conditions. Most investors interpret central bank gold purchases as a reaction to inflation spikes, but inflation itself is often a secondary effect of deeper liquidity dynamics that are already in motion long before consumer price indices reflect them. By the time inflation becomes visible in public data, central banks have usually already adjusted their reserve strategy in anticipation of sustained structural pressure rather than temporary price fluctuations. There is also a psychological bias among gold investors that leads them to assume central banks behave like retail investors at scale, reacting emotionally or tactically to price movements. In reality, central bank behavior is governed by institutional mandates that prioritize systemic resilience over entry price optimization. They are not trying to time the market in the way private investors do. They are constructing long-term reserve frameworks that must remain functional under multiple stress scenarios, including currency fragmentation, sanctions exposure, and cross-border settlement disruptions. This means that when central banks accumulate gold at levels that appear aggressive relative to historical averages, it is often not a signal of short-term market expectation, but a reflection of long-term confidence recalibration regarding fiat stability. And that recalibration does not reverse quickly because it is based on multi-decade assessments of debt trajectories, geopolitical alignment shifts, and trade dependency structures that evolve slowly but persistently over time. Another critical misinterpretation is the belief that central bank gold accumulation will always be accompanied by immediate price acceleration in the gold market. This assumption ignores the fact that central bank purchases are often executed in a way that minimizes market disruption. They are designed to be absorbed by liquidity channels without causing abrupt repricing until a threshold is reached where marginal supply becomes constrained relative to demand from multiple sources simultaneously. In many cases, central banks are not acting alone in the physical market. Sovereign wealth funds, large institutional allocators, and private accumulation trends often interact with central bank behavior in ways that are not publicly transparent. The combined effect of these flows can create a slow but persistent tightening in available supply, even if price action remains relatively subdued in the short term. This divergence between underlying accumulation and visible price movement is one of the key areas where most gold investors misjudge timing. Because they expect confirmation through price before recognizing structural change, they often arrive late to the most significant phases of revaluation. They wait for breakout confirmation rather than understanding that the most important signal is often not price itself, but the consistency and persistence of accumulation across entities that are not typically price sensitive in the short term. There is also a deeper strategic layer involving reserve diversification away from concentrated exposure to any single sovereign currency system. Central banks are increasingly aware that the global monetary system is becoming more multipolar, and in a multipolar system, reserve neutrality becomes more important than yield optimization. Gold, in this context, functions as a non-liability asset that can be carried across different monetary regimes without dependence on issuer stability or political alignment. What this